Today, we turn to a text written over a century ago, Reminiscences of a Stock Operator. This is not just a biography of Jesse Livermore. It is a fundamental study of human psychology under the pressure of capital. The market, regardless of the era, whether it is the paper stocks of the early 20th century or the high-frequency algorithms of today, always exploits the same emotional vulnerabilities inherent in every human being. The illusion of quick riches, which attracts millions of new traders, quickly shatters against the granite wall of market reality, where execution speed and depth of analysis are decisive. Livermore understood, success on Wall Street is not a matter of luck or insider information, but a strict, uncompromising discipline requiring mental fortitude. It is this distinction between dreamers and realists that shapes the statistics we discuss, relentless and harsh. Our task is to extract a structured methodology from his experience for operating in today's volatility.
Livermore started as a tape reader, a reader of the tape, and this serves as a metaphor for modern order flow and volume analysis, understanding who is moving the price and with what force. He quickly realized true capital is made not through daily hustle, but by sitting in the right position during a significant trend that develops over weeks or months. This requires absolute resilience to micro-movements and noise created by amateur speculators entering and exiting the market chaotically. His key takeaway was that big money lies in the big movements, and a trader must be patient, like a hunter waiting for their moment. Most traders, conversely, seek instant gratification, and this impulsiveness becomes their financial death warrant. They focus on volatility, while professionals focus on structural changes in market architecture.
The main lesson of the book is that the market is never wrong. Only individual traders are wrong, those who ignore obvious signals of a trend change. The market always moves along the path of least resistance, and the task is not to predict this path, but to identify it early and follow it without emotional involvement. The successful 5% use the market as an objective court that tests their hypotheses, while the other 95% perceive price action as a personal insult or betrayal. This sentimental approach to trading, where a trader hopes that the price will return, is a direct path to account destruction. We must learn to see the market as a high-precision mechanism, responding to massive liquidity flows and not to our personal expectations. Objectivity is the most expensive asset of a professional speculator.
Are you looking for the holy grail of trading? It's right in front of you. Reminiscences of a Stock Operator by Edwin Lefevre is not just a book, it is the Bible of financial markets, tested by a century of time. Discover the secrets of the legendary Jesse Livermore, how to read the market, how to master your own ego, and why big money is made not in the trading, but in the waiting. Only fundamental psychology, only priceless experience that remains relevant today, from stocks to cryptocurrencies. Stop being fuel for the market. Become a professional. Your path to consistent profit starts here. Click the link below the video and order your copy right now.
Livermore's analysis confirms the greatest losses are suffered by those who try to trade every day, fighting a market that offers no high-probability setups. He emphasized, money is made not by activity, but by waiting, when all factors align into a perfect configuration, which he called pivotal points. In the era of algorithmic trading, where noise is at its peak, the ability to sit on the sidelines and preserve capital is no less important than the ability to pull the trigger. Only when you see clear volume accumulation and the price begins to move toward a breakout of resistance or support, only then should you act aggressively. This principle protects against the exhaustion effect, where a trader wastes capital and mental energy on futile micro-trades. High trading frequency almost always correlates with low decision quality.
The Livermore approach requires a radical shift in perspective, from how much can I make today to how much can I protect this week. If a trader does not understand that their first task is to preserve operating capital, they have already lost, regardless of how many successful trades they had at the start. This is a fundamental asymmetry of mindset that separates stable traders from those who burn out quickly in the fires of speculation. Professionals see losses as part of a business model that must be minimized, while amateurs view losses as a temporary failure that must be urgently won back. We must accept that losses are the price of learning and an inherent part of trading, but their size must be strictly limited, even before the trade is opened. Only such an approach preserves the emotional and financial capacity for the next, more profitable opportunities.
The primary cause of financial collapse for the 95% is the inability to admit defeat on time, allowing small losses to turn into catastrophic losses that violate risk management rules. This paralysis occurs when a trader's personality becomes inextricably linked with the success of a specific position, turning objective trading into a subjective conflict. Livermore was categorical. You must be ready to close a position instantly when the market proves you wrong. Otherwise, your overconfidence will be financed by your deposit. Hopes and desires are the most dangerous emotions in the market, as they force one to ignore real volume and price data. Relinquishing emotional attachment to a trade is not a display of cold-bloodedness, but the highest degree of professionalism. Failure to adapt to market conditions breeds cognitive dissonance, when a trader consciously ignores negative signals to maintain their original hypothesis. Remember, when the market contradicts your initial thesis, immediately reduce exposure by 50%, regardless of your initial stop-loss placement. A losing trader continues to average down their position, hoping for a bounce, thereby multiplying risk instead of reducing it. This classic mistake, described by Livermore, is the direct opposite of the principle of successful trading. You should make money on positions that show a profit from the very beginning. Never average down on positions that are already in a loss. This is not an investment, but a high-stakes game of roulette. Fear of giving back profits forces traders to close successful positions too early, limiting potential gains and undermining the mathematical edge of their system. If a system has positive expectancy, it requires successful trades to pay out significantly more than losing ones, but emotional fear often forces one to lock in a small gain. Livermore urged, "Let your profits run," and this is the most difficult psychological task, especially when unrealized profit reaches significant levels. Remember that profit is unrealized until the position is closed, but it should not be closed solely due to psychological pressure. For a professional, stop loss and take profit are elements of the plan, not emotional triggers. The excessive influence of social media and news headlines on decision-making is another major reason why most traders lose control of their strategy. The constant flow of hot tips and insider information creates the illusion that one can beat the market by acting on rumors. Professionals, however, understand the market has already integrated 99% of news into the price by the time it appears on public resources. The actions of institutional players are based on market structure and long-term financial flows, not on headlines designed to grab the retail investor's attention. Your trading plan must be your only constitution, regardless of what financial gurus or analysts say. Inconsistent position sizing, where a trader risks more after a winning streak and less after a losing streak, destroys the mathematical foundation of any system. After a few successful trades, overconfidence sets in, leading to an oversized position which wipes out all previous profits during the inevitable setback. Livermore called this trading on nerves and insisted on maintaining a constant, strictly defined risk per trade. Your system must withstand a series of losing trades without threatening your core capital, and only a constant risk size ensures this resilience. Discipline in risk management is not an option. It is a prerequisite for long-term survival in the market. Livermore often said that big money is made not in the buying and selling, but in the waiting. And this is a direct contradiction to the cult of constant activity prevalent among novices. He did not trade until the market offered clear, unambiguous signals, which he called points of least resistance. This means that a trader should spend 80% of their time in analysis and 20% of their time in actual trading, and not the other way around.
Waiting allows you to avoid high-frequency noise created by algorithms and focus on the formation of real trends that will have enough momentum for significant profit. Only when the chart looks right and is confirmed by volume is it worth risking capital. Reading price movement should be a purely mechanical process, where the trader identifies accumulation or distribution, rather than guessing where the price will go next. Accumulation of large volumes at a support level without a significant breakout is a clear signal of a potential reversal upward, because institutional money is absorbing the supply. Conversely, distribution is a process of quietly selling large positions at highs, which often precedes a sharp drop. These phases require a deep understanding of volume analysis and market profile to distinguish panic from purposeful institutional work. Without this fundamental understanding of market structure, a trader is operating blind. Successful traders focus on larger timeframes, from daily to weekly, because that is where real sustainable trends form, ignoring the volatile sentiments of intraday trading. Smaller timeframes, such as 5-minute or 15-minute charts, are merely sources of noise and emotional traps, where it is easy to fall under the influence of momentary liquidity fluctuations. Livermore could not have known about modern timeframes, but his principle, tracking big moves, remains steadfast and universal. Shifting to the analysis of higher charts instantly reduces trading frequency, increases signal quality, and lowers the emotional burden on the speculator. The importance of recording all trading decisions in a detailed journal cannot be overstated, because it is the only way to objectively evaluate strategy effectiveness and identify personal biases. A trading journal should contain not only entry and exit parameters, but also the trader's emotional state, the reasons for the trade, and the subsequent behavior of the price. Such systematic analysis allows for the identification of recurring mistakes, for example, the tendency toward FOMO or exiting too early. The journal is your primary tool for self-reflection, turning trading from a gamble into a structured business.
The Livermore principle of not arguing with the market means once the stop loss is triggered, the trader must accept the loss and step away, without trying to immediately revenge the market. Many traders, after losing a certain amount, immediately open a new, often larger position to recover losses, and this act of emotional revenge is destructive. A professional, after a loss, takes a pause, reviews their analysis, and waits for the next clean setup, perhaps even the next day. This ability for immediate surrender to the objective reality of the market is the key difference between the 5% who succeed and the 95% who lose.
Success in trading is not just about profit, but primarily about impeccable risk management, which ensures that no single trade can destroy the entire operating capital. The fundamental rule is that risk per trade should never exceed 1 to 2% of the total capital, allowing one to withstand long losing streaks. Most traders violate this rule as they try to accelerate the wealth-building process, betting 5 or even 10% on a single position. Such aggressive use of capital, in just a few wrong decisions, nullifies years of potential work. Proper position sizing is more important than the precise determination of the direction of movement, and this is a hard mathematical truth ignored by novices. Position size should be a function of risk and not of capital, meaning you calculate how many shares or contracts you can buy based on the distance to your stop loss and your maximum allowable risk. If the stop loss is far away, you automatically reduce the position size to maintain the same level of risk in currency. This protects the trader from over-leveraging and forces them to think in terms of probability and capital preservation.
The mistaken application of epistemology in trading, where a trader is convinced they know the future, leads to fatal overestimations of risk. Advice: base position size on the realized volatility of the last 20 periods and not on a fixed percentage of capital. There is no absolute certainty in the market. There are only probabilities that constantly change, and a professional always trades based on the assumption that their analysis may be wrong. This humility before the market is the mental stop loss that precedes the physical placement of an order. Recognizing one's own limitations forces the constant use of rigid protective mechanisms. The use of trailing stops is critical for maximizing profit after a position becomes profitable, protecting already earned money from an unexpected reversal. Professionals don't just set a stop-loss, they actively manage it, moving it to a break-even state or locking in part of the profit as soon as the price clears a key level. This disciplined management of a position in dynamics differs from the static approach of novices who leave the stop at the initial level. This allows the trader to let profits run while simultaneously protecting what has been accumulated.
Correlation risk is an often ignored factor when a trader opens several positions that, essentially, depend on the same macroeconomic or sector driver. For example, opening long positions in 7 different tech stocks during a NASDAQ rally is a form of non-diversified betting where all trades can crash at once, or to 5%. This protection against systemic shock is vital for preserving capital during periods of market panic. Succumbing to survivorship bias means looking only at the stories of successful traders, ignoring the thousands who failed, which creates a false sense of ease in achieving results. Perceive every successful trade as a statistical anomaly, which requires heightened risk analysis for the next entry. This mental trap forces novices to copy methods without understanding the fundamental discipline that lies at the heart of consistent success. Realizing that the market is a zone of high competition and constant threat forces a trader to always reevaluate their assumptions. The market demands humility, and ignoring the failures of others is the fastest path to your own defeat.
The pursuit of external validation, whether confirmation of a trade from a guru or approval of a decision in a community, is one of the most destructive factors destroying a trader's objectivity. A professional trader works in mental isolation, relying solely on the objective data of their chart and the mathematical advantages of their system. If you open a trade and then run to forums or Twitter to make sure you did the right thing, you have already lost control of the situation. This indicates a deep insecurity in your own strategy, which will inevitably lead to impulsive closing or overholding of a position. To fight this destructive urge, we introduce the checklist, protection from validation, which needs to be checked before and during trading, whenever the urge to turn to external sources arises. First point, was the entry confirmed by 3 unrelated technical indicators that you usually use, or did you act on emotions triggered by external advice? Second point, am I ready to increase risk if my trade does not meet expectations, simply because I trust an external source? Third, is the stop loss fixed at a level that is mathematically sound, or is it set in a place that looks good for a public post?
The philosophical concept of solipsism in trading can be useful if applied as a methodological tool that states only your strategy and the market exist, and everything else is noise. A market signal is valid only if it is confirmed by 2 non-correlated technical indicators on separate time intervals. The external voices you seek for confirmation do not have your stop loss nor your deposit. Therefore, their opinion is completely irrelevant to your financial result. If you doubt a trade, the problem is not in the market but in your analysis, and no external voice can fix that. Your decision must be final and internally motivated, based on clear rules, not on consensus. Consider a live micro scene. A trader opens a long position in stock XYZ, relying on a strong breakout with high volume on the daily chart. 10 minutes later, during a minor consolidation, he sees a tweet from a popular analyst claiming that this bounce is a trap, a sharp drop is expected. The reaction of an amateur trader, he immediately panics and closes the position with a minimal profit or even a small loss, violating his original plan. The reaction of a professional, he checks the checklist, sees that the stop loss is not broken and the volume on consolidation is low, ignores external noise, and continues to hold the position. This is a simple but decisive difference: discipline versus impulse based on someone else's opinion.
Point 4 of the checklist. Is my potential exit from the trade dictated by a desire to avoid criticism or a desire to confirm my genius, or is it driven by a breakout of a key level? Point 5. Am I ready to defend my position, even if it temporarily shows a loss, because I trust my analysis of market structure? If the answer to these questions leads to doubt, one should immediately reduce the position size to lower the emotional burden. The checklist serves as a mental filter, allowing one to separate objective trading reality from subjective social pressure. External validation is a psychological mechanism that replaces the need for deep, independent analysis, which is fundamentally dangerous in a competitive market. If your strategy requires constant confirmation from the outside, it is not a strategy, it is a form of financial dependency that makes you vulnerable to manipulation. The successful 5% of traders are self-sufficient analysts who fully own their methodology and take full responsibility for their results. They understand that the market pays for uniqueness and independence of thought, not for following the crowd.
Contrary to popular myths about big players who consciously hunt retail stop losses, the modern market is driven by algorithmic systems, which react to liquidity volume and imbalances in order flow. These institutional flows have no emotions or intent to rob a specific trader. They simply optimize the execution of large orders with minimal price impact. Retail traders become fuel for these flows because their small but numerous orders create liquidity at suboptimal points where big players can enter or exit a position. Understanding market structure requires analyzing high volume zones, volume profile, which indicate price levels where significant battles between buyers and sellers took place. These zones often serve as support or resistance points because institutional participants have a significant interest in defending or breaking them. Ignoring these volume levels and trading based on simple trend lines is a serious mistake, as these simple tools do not account for the depth and strength of real liquidity. Professionals trade based on realized volume and not on visual illusions.
Market behavior often demonstrates reflexivity, where price movements themselves shape news and sentiments, which in turn reinforce the initial movement, creating self-sustaining cycles. Remember, if a news event confirms a steady trend, expect a high-voltage reversal within the next 72 hours due to a large rotation of profit-taking. A successful trader understands news is often a consequence of price movement, not its cause, especially when dealing with large established trends. This requires a critical attitude toward any published information, as it can be used to create liquidity traps. Analyzing delta volume, the difference between market buys and sells, allows one to see the true pressure in the market, distinguishing aggressive buyers from passive sellers, which is key to identifying reversals. If the price is rising, but delta volume is decreasing or remains neutral, this may indicate trend weakness and liquidity absorption at highs. This is a subtle but important tool, helping you see what is hidden from the majority who rely only on price candles. Ignoring delta is ignoring the true intent of market participants.
Liquidity in the market, especially in Forex and crypto markets, tends to gravitate toward obvious stop-loss levels, creating liquidity trap zones. Institutional algorithms may briefly sweep these zones to execute their large orders at a better price, which leads to sharp price spikes that scare retail traders. Professionals place their stop losses a bit further from obvious technical levels or use mental stops altogether to avoid these liquidity traps. This requires surgical precision in defining the entry level to have less risk per trade. Discipline in trading also means the ability to ignore the magnetic effect of round numbers like $100, $1,000, which often act as psychological resistance for novices. While these levels may have value, they are rarely the best points for entry or exit because it is where the highest concentration of retail orders is located. A smart trader looks for confirmation of important levels through volume and not just through the psychological appeal of the price. Exiting a position should be driven by a change in volume structure and not by reaching a pretty number. Livermore formulated a principle. You can never enter the market with all your capital at once, even if you are completely confident in your analysis. Instead, use the pyramid method or probing positions. First, a small position is opened, and only if it immediately yields a profit, the trader adds the next part to it, raising the average price, but confirming their initial thesis. This method ensures that you aggressively invest only in those positions that are already moving in the right direction, minimizing risk on stalled positions. This is the complete opposite of averaging down losses. The successful 5% never trade based on "I must" or "I feel."
Instead, they trade based on if-then conditions, which are part of their mechanical system. The trading plan must be written on paper and followed implicitly, even if it contradicts internal emotions or the intuition of the moment. If your system requires closing at a certain level, you must close the position, regardless of rumors of rapid growth that may appear in the media. This automation of decisions is the primary defense against the human factor, which is the main source of losses.
The danger of margin trading, described by Livermore, is today amplified by easy access to large leverage, allowing novices to quickly accumulate ruinous losses. Using excessive leverage increases both potential profit and the speed of reaching a margin call, turning even minor market fluctuations into a catastrophe. Professionals use leverage selectively and with extreme caution, always leaving a large capital buffer to cover unpredictable movements. Livermore understood that having free capital at a critical moment is the most valuable asset. Livermore resolutely rejected the need to be in the market constantly. Instead, he promoted periodic exits from trading for an objective assessment of the situation and rest. When the market is uncertain or when the price is moving in a sideways trend without a clear direction, the best decision is to preserve capital and mental clarity. This rest allows one to avoid losses associated with boredom and the desire to just play, which are common among amateur traders. Preserving capital during uncertainty is a form of earning because you reduce risk.
Successful traders always concentrate their capital on a few assets, which they understand and constantly track, instead of spreading themselves thin over dozens of incomprehensible instruments. Deep knowledge of the dynamics of one market, for example, the tech sector or a specific currency pair, provides an advantage that cannot be obtained by trading everything at once. Livermore always focused on stocks that showed the greatest strength or weakness, ignoring the rest of the market, which moved without sufficient momentum. Depth of analysis is more important than breadth of coverage. Professionals are never afraid to sell short on a bear market, realizing that the price can fall just as fast or even faster than it can rise, whereas novices tend to trade only long. True financial resilience requires the ability to earn in both directions of market movement, which requires giving up psychological bias against falling prices. This flexibility in views allows traders to thrive even during financial crises, when most surrender. The market does not know what is good or bad. It only offers opportunities.
The key difference is that the 5% of traders constantly improve their system, adapting it to the changing structure of the market, whereas the 95% search for a grail, a fixed, perfect strategy that will work forever. The market is a dynamic system, which requires constant rule review, adjustment of parameters, and implementation of new tools, like machine learning analysis or new types of volume indicators. The ability for self-criticism and continuous learning is a mandatory prerequisite for long-term success.
The secret of success is not in having unique information, but in having higher quality of execution of standard, proven principles of risk and position management. No technical strategy will save a trader if they do not master the mental aspects, patience, discipline, and the ability to admit mistakes. Livermore proved that the market is a playground where the most adaptive and emotionally resilient win, not the smartest. Your job as a trader is a continuous battle with your own ego and the pursuit of quick rewards. Integration of Livermore's lessons into modern trading requires a strict refusal of intraday hustle if you are not a professional day trader with access to institutional tools. Instead, focus on swing trading and position trading, where you catch big trends, minimizing the impact of high-frequency noise. Check if your average trade duration matches your ability to withstand volatility. The less you look at the chart, the fewer impulsive decisions you will make.
Overcoming emotional dependency on constant profit requires awareness of hedonic adaptation, when a trader gets used to success and becomes negligent in risk management. Advice: after reaching a quarterly profit, dedicate the next 4 weeks exclusively to low-frequency, high-probability setups. You need to consciously create pauses and restrictions so as not to let success become the cause of the next big failure, which is a classic crash cycle. A professional trader knows when to stop even when they are winning. A practical mini-assignment for everyone who watched until the end. During the next week, regardless of the result, you must keep your trading journal, but add a separate column, Source of Validation. Every time you feel an impulse to trade, you must clearly record whether it was a decision based on your system or on external noise, like a tweet or advice. Analyze at the end of the week how many of your losing trades were caused by external validation. This exercise is the first step toward liberating your trading from emotional slavery.
Stable success on financial markets is not a mystery, but a clearly defined strategy where psychological advantage dominates over technical complexity. This is what Livermore proved a century ago, and it remains true today. If you are ready to take full responsibility for your decisions and give up the hope for easy luck, you have already separated yourself from the crowd. Tell us in the comments, which of Livermore's principles, patience, discipline, or risk management, is the hardest for you to execute? Share your thoughts so we can build a community of true, disciplined professionals.